How's it going, everyone? This is Nick. I am back here with another market deep dive. Super excited to bring this data to you guys, real-time data on real estate markets across the country, helping home buyers, helping investors make more educated decisions. And in today's episode, we're going to take a look at the Washington, D.C. real estate market. Now, this is one I've been getting a lot of requests on from you guys. We have a lot of potential home buyers and real estate investors in the Washington, D.C. metro area, and it's actually a super interesting real estate market to analyze because there's so many different neighborhoods, so many different zip codes, lots of different areas of growth. So a lot to sink your teeth into from a data perspective. So what we're going to do in this video is two fundamental things. The first thing we're going to do is analyze whether Washington, D.C. is a safe place to buy real estate in 2021. If you've tracked my videos this far, you'll see that I'm pretty skeptical of the overall housing market right now. I believe we're in a housing bubble that's set to collapse. So for that reason, you need to pay even more attention to the specifics of the local market you're looking into. So we're going to answer the question, number one, is DC safe to invest in? And then number two, if you are going to invest in Washington, D.C., what are the best areas to do it? What are the zip codes in the neighborhoods with the most growth, the most affordable prices, the most appreciation? What are the zip codes in the neighborhoods that you'd want to target from a real estate investment standpoint? So without further ado, let's get into it. So Washington, D.C., obviously it's the seat of the U.S. federal government, and that drives a significant portion of the real estate market. When you look at percentage of people that work in government or ancillary industries like law and lobbying, it's well over 35% of the area workforce. So the federal government, that's a huge driver, but that's not the only thing DC has going for it. There's now a very vibrant tech scene exploding in the DC area. The amount of new startups and venture capital backed firms, especially ones in biotechnology and IT cybersecurity, those are increasing significantly in DC. So you have a good array of both stable and growing demand drivers. However, in terms of understanding the real estate market, we need to go from looking at the economy to looking at real estate prices. And how high are real estate prices in DC today? And how high are they relative to what they were 10 to 20 years ago? So on this graph, we're looking at the typical home price in the Washington, D.C. metro area. And just to be clear, that metro area, that includes D.C. proper, but it also includes surrounding counties like Fairfax, Virginia, Arlington, Virginia, Montgomery, Maryland, Prince George's County, Maryland. Kind of the whole general area is baked into this number. And we can see that the typical home price in D.C., according to data from Zillow, is $490,000 in March 2021. That compares to a U.S. typical price of $277,000. So immediately you can see that D.C. is expensive. It's almost 2 times higher than the average price across the U.S. It's not surprising. DC is a dense area, right? High density, not a ton of new building, and obviously a lot of high income jobs, a lot of government jobs, a lot of stable jobs. So that's why prices are high in DC. But we can see if we look back historically that prices weren't always as high in DC. If you go back to, let's say, 98, DC's typical price was $180 compared to a US average of $115. So DC and the US used to be much closer in terms of their home price. And then we can see that DC had a big increase in the mid-2000s during the previous housing bubble. Prices, wow, more than doubled in the span of 6 years. They went all the way up to around $470,000 in 2006, and then they proceeded to crash all the way down to around $335,000 in 2012. So I think the question on people's minds is DC going to crash again? Right? You know, we're back up at a new high of 490,000. Can we expect similar action to what we saw in the mid-2000s? Or is this number, 490, a lot more stable today than it was 10 to 15 years ago? Now, to answer this question, it's really important to think about what are the fundamental drivers of real estate values. And on this channel, I talk a lot about the Holy Trinity of real estate investment, and that's looking at 3 fundamental things: economic growth, investment security, and housing shortage. And let's just touch upon that last point for a second now with DC, housing shortage. If a market is experiencing a shortage of housing, aka not enough new housing is getting built, right, to house its population, its growing workforce, that's going to push prices up and give greater support to real estate prices. If a market is building too much new housing, well, then they're in a housing glut, and that causes a lot of downside risk for real estate. DC is a market that in the mid-2000s, early to mid-2000s, it was in a housing glut. Quite simply, back around 2002, 3, 4, DC was building so many new homes and new apartments, way more than what was needed. And that was one of the reasons why DC had such a big crash over the next 4, 5, 6 years, is because they were just building too much new real estate. And the thing is, today it's the complete opposite. DC is not building enough new housing for its population in 2021. It never got back to those same levels it was building in the early 2000s. And you can see what I'm talking about on this graph, where we look at a statistic I call permit percentage. And that's taking the amount of permits pulled for new homes and apartments. You know, when a developer wants to build a new home or apartment, they go to the local zoning and planning, they pull a permit to build that unit. It's taking the amount of permits pulled over the preceding 12 months and dividing it by the total jobs in the economy. So you can see DC back in the early 2000s was permitting a lot of new homes and apartments, a permit percentage around 2%. Right, so you can see, for instance, in 03, 57,000 permits pulled compared to 2.8 million jobs. That's a 2% permit percentage. So I spend a lot of time on working on these videos. I love sharing this data with you guys. In return, all I ask is just please hit that like button, and then please leave a comment on the video. Hitting the like button, leaving a comment, that tells YouTube it's a good video, gets me a little bit more exposure, and allows me to interact more with you. I want to hear what you have to say. Do you agree with me? Do you disagree? Especially if you live in DC, I definitely want to hear what you think about the DC real estate market. So again, make sure to like, leave a comment, and then also subscribe if you haven't done that already. All right, let's get back to the video. Of course, like what happened in most markets, is that during the great financial crash, the amount of new building just plummeted, all the way down to like a pathetic 0.4% permitting supply expansion. So we went from permitting a lot of new housing in DC in the early 2000s, which helped cause the crash, to permitting very little new housing. And then there was a kind of a rebound, 2013, 2014. But since then, we've kind of stayed in this range of 0.8 to 0.9% permitted percentage. So DC today is building half as many new homes and apartments relative to its job and employment base than it was 15, 20 years ago. And that should make you feel more confident investing into DC now, right? If we're not building as many new homes and apartments in DC, there's not as much new supply. It makes it less likely that there's going to be a housing glut in Washington, D.C. So I think that's point one for why the $490,000 typical price across the metro in D.C. today is much more legitimate than the prices of 15 to 20 years ago, and would make me feel more secure about investing in a market like DC today. However, there's an additional component that makes me feel comfortable, and that's looking at investment security, the second peg of the Holy Trinity. And when I talk about investment security, what I'm really talking about is the relationship of prices to wages in the local economy. That's something I call value to earnings ratio. When you look back historically, value to earnings ratio, it's a very predictive metric for when a market is in a bubble or whether it's undervalued. Basically, the higher that prices are, right, the higher the prices are relative to incomes, the more bubbly the market is. Because after all, it's wages and incomes which determine home prices fundamentally, right? People get loans based off their wages and income. They earn their down payments based off wages and income. It's so that wages and income, which is really important for establishing the fundamentals of a market. And what's happened in DC is that the relationship of prices to earnings today is much more sound than it was 15 to 20 years ago. They're much closer together, which means it's much less likely that DC is going to have a big housing bust. And you can see what I'm talking about here on this graph. So again, we're looking at value to earnings ratio that's taking the typical price of a home in the metro and dividing it by the average earnings of the average worker in the economy. That's data that comes from the Bureau of Labor Statistics. And again, if we go back to 07, we can see a figure of 9.4. So in early 07, typical price in DC was $460. Annual earnings were $49,000 for the average worker. That's a relationship of 9.4 value to earnings. It's pretty high. But then, of course, what happened? From a high value to earnings, it went from a low value to earnings as prices crashed in the market, all the way down to around a 6x VE ratio in 2012. And what's happened since then is actually a really good thing, is that value to earnings, it's gone up a little bit, right? Up into the high sixes, around 7. But value to earnings, it's stayed relatively stable over the last 10 years, which means that wages are keeping pace with home prices in DC. That's a good thing for the health of the market, that wages are keeping pace with home prices. And you can see there's been a bit of an increase in 2021. We're now up to value of 490 compared to earnings of 68,000. That's a 7.2 value to earnings. But this is much lower and much healthier, right? 7.2 is much lower than the 9.4 that it was experiencing in the mid 2000s. Another way to show kind of the relative security of DC's markets to compare it against another city. So what I did here is we're still looking at value to ratio in DC, the blue line, but now we've added Austin, Texas, the yellow line. So you can really get some perspective of DC's relative value and security today. So again, if we go back to 2007, we see DC super expensive, 9.4 value to earnings. Austin was around 6. So Austin was much more cheap on a relative basis than DC. Value to earnings declined in both markets up to 2013. But then since then, Austin prices, this yellow line, the prices in Austin have just gone berserk up to the point today where the value to earnings in Austin is 7.9. It's actually higher than the 7.2 in DC. So what this graph is saying is that DC, despite it being like a super dense market, lots of high incomes, lots of, the seat of the US government, you would think things that would make DC very expensive. It's actually a more affordable market on a relative basis than a place like Austin today. And this is something that you really need to consider, right, in 2021 if you're looking to buy a home or investment property, because real estate prices in aggregate have never been higher, right, across the country. So you really need to focus on the specifics of your market. Does my market have good fundamentals? Do prices match up to earnings? Do prices match up to rents? What are the trends in both of those things? In a market like DC, not to say that it doesn't have some downside if there's a crash, but it certainly has less downside than a market like Austin, which has just gotten so expensive so quickly, whereas a market like DC has basically stayed steady in its relationship of values to wages and income. Now, I know the next question on everyone's minds, if you're a home buyer or investor in DC, you want to know, where should I invest, right? Because the DC metro is a massive, massive place. It's about a 60-mile radius actually into all the outlying counties. So you really want to understand what are the best areas within DC to invest, because not all areas are created equal, right? Some are more expensive, some are more affordable, some are higher growth, some are lower growth. So you really need to understand the specifics of neighborhood and zip code in terms of your real estate investment decision. Are you a home buyer who wants to buy something in a, let's just say a nicer, wealthier, more established neighborhood? Well, there's certain zip codes you should look at. Are you a home buyer and investor who's looking for more upside? Maybe you're okay with being in an area that's not as nice, but you like the upside and growth potential. Well, that's something you should know and you should look at. So let's start by understanding the affordability of DC. Where are the expensive areas? Where are the inexpensive areas, relatively speaking? So on this map, we're looking at every zip code in the DC metro, and the color coding shows the price of real estate in the zip code. So the more magenta or purple it looks, the higher the price. The more translucent or blue it looks, the lower the price. And the first thing that sticks out is that there's lots of differences in affordability and how expensive real estate is throughout DC. I mean, the first thing that jumps off the page is that we have this kind of northeast quadrant, right? This northeast of the central DC area. So this would be central DC, kind of where the White House is in this area. This whole magenta region here is where there's really high home prices. We have 20007, that's Georgetown, typical price of 1.2 million. We go up to 22101, that's McLean in Fairfax County, Virginia, typical price of 1.3 million. We go up to Chevy Chase, Maryland, zip code 20815, typical price of 1.2. So really it's this area to the northwest of DC that is just tons and tons of wealth, tons and tons of income and high home prices. Now, if we zoom out, we can see that the eastern side of the metro is much more affordable, right? And this is in Prince George's County, Maryland. We see prices of around 300,000, 290, 298, 340, 363. Now, these are typical prices that actually would be kind of expensive in a lot of other cities, but because DC is a high price metro overall, 300 to 350 just isn't as expensive. But what's very clear is that the northwest side of the DC metro, really high prices, really expensive. Really, the whole eastern side, much more affordability. And so again, like I said, if you're a home buyer who's looking for an established neighborhood, a really nice neighborhood, maybe you look to some of more of those northwest zip codes, McLean, Fairfax County, or Chevy Chase in Montgomery County. Maybe those would be the areas you look. Potentially Georgetown, if you're looking for more of a growth opportunity, right? An area that might have more upside appreciation potential, you probably go east into Prince George's County and some of those zip codes. And DC, like many other markets that I've covered in these deep dives, if you look at appreciation rates over the last 5 years or so, you'll see big differences in appreciation depending on affordability. Just has been the case in most other markets. The more expensive areas in DC have had lower growth. The more affordable areas have had higher growth. And this is a trend that we've seen across almost every market that we've looked at. I think this is the 17th or 18th market deep dive. Make sure to check out the other ones in my video history. In almost every single city, it's the affordable zips that see the most appreciation and the expensive zips that see the least. And you can see that represented on this map, which again, we're back to zip codes, but the color coding now is looking at the appreciation rates over the last 5 years. The higher the appreciation, the more purple magenta, the lower the appreciation, the bluer it is. And right off the bat, we see a kind of a trio of zip codes here, 20019, 20032, 20748. We're seeing like 67%, 52%, 64% value appreciation in these zip codes over the last 5 years. That's crazy growth levels, especially for DC, which has been a lower appreciation market in general. To see 64%, 67%, 52% over 5 years, that's massive growth for the DC metro. Now, if we zoom in kind of closer into core DC, we see the exact opposite. We have a zip code like 20009. That's seen only 10% appreciation. This would be kind of Adams Morgan, DuPont Circle, has seen only 10% appreciation over the last 5 years. That's less than 2% per year, which is basically at the rate of inflation, which is a negative return when you consider the fact that you have to pay property taxes and HOA fees and things like that. If we look, it's the similar story in 20036, 20005, really poor levels of appreciation in the central DC area. And then if we go out to the northwest as well, we're seeing lower rates of appreciation in these wealthy suburbs to the northwest. Now, I think in 2021, we got to be really careful about looking at historical appreciation as a benchmark for where we should invest. Some of those zip codes to the southeast of DC that have seen 50 to 60% value appreciation in Prince George's County, I'm a little skeptical of those zip codes because they are some of the highest poverty zip codes in DC, poverty rates above 30%. They're fairly high crime. I'm a little skeptical of how that type of zip code is going to behave if there's a housing downturn. Like I could see a zip code like that getting hit pretty hard. In fact, if you go back to the last housing crash, 06, 07, 08, it was those same zip codes, those high appreciation, but kind of low economic fundamental zip codes that got hit the hardest in the last crash. Now, it doesn't mean don't invest in those zip codes. Clearly, they have more growth potential, but that's just something to take into account if you're looking for growth and appreciation. Conversely, I would think that the center of DC might do a little better than it has over the last 5 years. I think Adams Morgan, DuPont Circle, Foggy Bottom, I think some of those neighborhoods have more appreciation potential in the next 5 years than they had in the last 5 years. I wouldn't be surprised if we see kind of a return to some of these central DC zips doing a little better. Now, the problem is they're super expensive, right? Typical prices of $600,000, $700,000. So it's hard to gain access to those areas. But if you can, maybe it's something that you consider if you're a DC home buyer or real estate investor. Now, the good thing is that values in DC in general in 2021 look a lot more secure today than they did, say, back in 05, 06. The lower permitting pipeline in DC, the substantially lower pipeline actually for the span of 5 to 10 years, means that there's more of a legitimate housing shortage in the city, which makes it less likely that values are going to crash the way they did in the late 2000s. Additionally, wage growth in DC has managed to largely keep up with home price growth over the last 10 years. That's also a good thing. So the relationship between home prices and wages in DC is a much more solid level today than it was 15 years ago, and it's a much more solid level than, say, growth markets like Austin, Salt Lake, and Boise are right now. DC presents a lot better relative value in the local real estate market compared to what people make and earn. So I hope you guys enjoyed this video. If you want to learn even more about real estate, about what I do, go to www.reventureconsulting.com. That's my company's website. Go on reventureconsulting.com, take a look around, and then submit a contact form if you want to learn more. Tell me a little bit about yourself and what you're looking to do in real estate. I provide one-on-one coaching services where I help clients learn how to use data, real-time data from sources like the Bureau of Labor Statistics, U.S. Census Bureau, and Zillow. Use this real-time data to make more informed decisions about when and where to buy real estate, whether it be a home or an investment property. Using this data will help you make more informed decisions in what amounts to, the largest, biggest financial decision in most people's life. So go to www.reventureconsulting.com, leave a contact form. Additionally, if you're annoyed that I only post 2 to 3 videos per week and you want more content, well, then you should subscribe to my Instagram at reventure_consulting. That's at reventure_consulting. I post new graphs, charts, and maps every single day on real estate. I also post stories of me explaining what they mean. So if you want daily content, subscribe to my Instagram. Until next time, this is Nick from Reventure Consulting signing off.